Hello and welcome to another episode of Smart Money. Now, in today's episode, we will help you understand how to build a portfolio at a time when there are two big events upon us. One, of course, the elections, and two, we're probably entering into a rate-cutting cycle. We will be drilling it down to specific themes and funds and also take up all of your queries. Joining us today on the show is Anupam Guha. He is the head of Private Wealth Management and Investment Advisory at ICICI Securities. Now, Anupam has over 15 years' experience in the private banking business, both in India and overseas. He is one of the founding members who helped set up the private wealth management business at ICICI Securities as well. Anupam, thanks a lot for joining us here in the studio. You know, first I want to ask you about what your approach is to portfolio construction for clients as we are heading towards the 2024 general elections. I'm asking because this is, in any case, a very challenging time for the market, and now we have both the start of a rate-cutting cycle and the elections upon us. How does one construct a portfolio?
Yeah, thanks, Sonia, for having me at the show. When investors ask us, I think our response is really that the broad concept of portfolio construction, revolves around the concept of asset allocation. And asset allocation is nothing but a structured method and a framework for really, one, understanding the investment objective of the customer, of the investor. And second, then is to create the framework of, putting that money in various asset classes. Now, if I were to just, kind of explain, like in personal finance, we all know the personal part tends to be far more important than the finance bit, right? Because the same advice that, I give could mean different things to different people. So, the 5 things that one needs to really look at when creating the asset allocation framework in terms of setting the objective. One is in terms of the return expectation of the investor, the risk appetite that an investor may have, the liquidity, what kind of cash flows does he need, what is the tenor of investment that he's looking at, and really the taxation bit. Once we've established that, then really, you create an asset allocation framework, which broadly has 2 components. One is the strategic asset allocation, the other is tactical. Strategic is long-term, really in line with, the framework that we've created. But tactical is where, one can really take positional calls, depending on how you see the macro, the market, and election, or the 2 events that you spoke about, really gives an opportunity for investors to kind of do some tactical, rebalancing, rejig, and take this as an opportunity for building a portfolio.
Okay, that's interesting. So how do you see the past elections and the returns from the market? Is there a correlation? I mean, for someone, say, if somebody has been in the market for 20 years and has not really bothered too much about the election and the outcome, is that a fair way to look at it, that elections come and go, but I shouldn't really tamper with my portfolio? Or do you think otherwise?
Yeah, so you actually, you said it. If you look at the last 4 elections, right, 2004, 9, 14, and then 19, right, you've had 2 UPA governments, 2 BJP, NDA governments, right? And if you look at the returns that came out of post those elections, in the near term, there would be volatility, because election is nothing but an event where there is an uncertain outcome, right? And that really makes our investors anxious. But really, if equity is, is something that you are looking at, or even from a debt perspective, broadly, you have a 3-year horizon. In a 3-year horizon, post-elections in each of these last 4 elections that have happened, investors have made double-digit return. So VIX or the volatility index typically tends to go up as you come closer to elections. But for long-term investors, it's really to, kind of hold your fort and really play to the India story.
Okay, play to the India story. So tell us a little bit about the themes, right? Over the next 12 months, given that we have elections upon us, as well as we have, a couple of other, perhaps a rate-cutting cycle as well, which are the sectors that you like at the moment and one that investors can participate in?
Yeah, so one is that we are broadly, quite constructive on the markets. Because, as I said, the India story, if you look at what's happening, be it reforms, the growth in infrastructure, the Make in India story, the digital story, regulation changes, both, the cleanup of balance sheets in India, I think it augurs extremely well. And, what we were discussing a while back, it seems to be a great place to be in India, because really, when you look at a per capita GDP movement from 2,500 onwards, right, what we've seen in China 20 years back, you really see the markets doing well, the economy doing well. And in context of that, specific to your question on the election bit, I think if you were to look at it, there are 2-3 sectors that really look appealing from a 12-month perspective. One is, in this budget, government has actually provisioned or budgeted for almost 10 lakh crores of capex expenditure, right? And if you see capex expenditure in the last 3 years, actually it's gone up by almost 33%. So in context of that, we feel that there is going to be a push in infrastructure, there's going to be a push on capital goods, and these 2 sectors look good. Also, to your point that you mentioned in terms of the interest rates, we are near peak. Yeah. And at some point of time, there is an expectation. Maybe it could be slightly more delayed than maybe later towards the end, in case if interest rates were to come down. And I think, in terms of commodity prices and raw material, which has had, I would say, a volatile phase, I think it is all getting stabilized, which means that margins will get normalized. And when margins get normalized, you would see sectors like cement, steel, auto, FMCG all doing well, right? So on one side, you have the infra and the capex, 2 core themes that and capital goods that one could look at from an investments perspective. And from a margin normalization, I would say some of these sectors also look good. Over and above that.
Just one follow-up here. So since we're talking about the rate cutting cycle, right, the fair assumption is that all the rate sensitives will do well, especially pockets like real estate. I mean, if the rates start to fall, it will be better for home buyers, perhaps. So real estate stocks will move. Is that a good way to look at it? I mean, is there alpha generation in some of these spaces? I mean, they've rallied quite a bit up until now already.
Yeah. So from an alpha generation perspective, I mean, when we do portfolio building, there are 2-3 things that we look at, right? I spoke about asset allocation as a core theme. And there are enough research papers which say that, listen, if you have to pick one thing which really has contributed to alpha creation, it is the asset allocation bit. Because if you look at broadly 3-4 parts of this various assets that are available for an investor to invest into, which would mean, say, for example, an Indian equity, it would mean global equity, it would mean debt, and, say, for example, gold on the alternate side. And if you look at the last 10-year data, the gap between the best performing asset class and the worst performing is closer to 20%. That's big, right? Which means that, say, for example, last year gold did well. Before that, equities did well. 2019, global equities did very well. Before that, 2018, debt was the best performing asset class. So from an investor's perspective, I think it's very important that you really build a portfolio which has components of these asset classes. The second part, within the investment that you're doing, and more so from an equity perspective, the point that you made, the sectors that one would want to look at, like real estate that you spoke about, right? If I were to look at some of the sectors, be it banking, IT and pharma, I mean, just post-COVID, if you were to look at those 2019-20 returns, IT and pharma were the best performing, themes or baskets. Now, obviously, like last year was FMCG. Before that, it was metals. So really, in case if one believes that interest rates are going to fall, right, rate-sensitive sectors will do well. And I think it is those tactical allocations that would really give a lot of, alpha to a client's portfolio.
Okay, let's do one thing. Let's take a short commercial break. We also are getting a lot of queries from our viewers, so don't go anywhere. We'll come back with our guest in just a bit. We'll also try to drill it to specific mutual funds, specific, assets that you can invest into. More on that coming up in a bit.